Hello, this is Chuck Carnevale, and with today's video, I'm going to take a FastGraphs Fundamentals Analyzer software tool look at why I've suddenly become interested in investing in Lowe's Corporation as a long-term total return opportunity. However, before I specifically look at Lowe's, anytime you look at Lowe's, you also think about Home Depot. In fact, many investors consider both Home Depot and Lowe's very similar investments. So I thought it would be interesting to first of all show you the long-term operating history of both first Home Depot and then Lowe's. What you see here on this graph is a plotting of the company's operating earnings per share. This is the dividends paid, and this is a plotting of the company's dividends while they're still part of the company. And this area below that is the dividend payout ratio. What I want you to notice here are a couple of very interesting things about these two companies. First of all, you can see that Home Depot has grown earnings at a rate of about 14.1% per annum. Now, over the same time frame, Lowe's has grown earnings at 15.4%. But what I really wanted you to notice here was how very similar these companies are. Now, here are the two recessions, the recessions of 2001 and the Great Recession of 2008 and 2009. Both Home Depot and Lowe's saw their earnings drop during the Great Recession. They actually grew earnings during the 2001 recession. But keep in mind, this is pretty remarkable when you consider the fact that this was primarily a housing-generated recession. On the other hand, the dividend continued to grow even through the Great Recession for Lowe's. Right now, the company is trading at a PE ratio of 17.9, blended PE ratio. A dividend yield of 2.1%, is A- rated, but does have 73% debt to capital. Now, before I go on, I just want to make a couple of comments about what I'm seeing here. I'm seeing a very consistent growth story, very low dividend payout ratios here. I've seen the dividend payout ratio increasing ever so slightly, and let's look at that. You can see here by looking at the performance results associated with that graph that their payout ratio was single digits for most of the period up through 2007. Then as we come through the Great Recession, their payout ratio has increased into the mid 30% range. Now you can see that graphically just by viewing the graph here. You can see that the area below the white line as a percentage of total earnings has increased dramatically. However, let's shorten the time frame now. Let's drop this down to post-recessionary periods from fiscal year 2011, which actually ends in January 31st to current. You'll see that Lowe's has grown earnings at 17.1%. The orange line on this graph represents a PE ratio of 17.1, which is very close to the current blended PE ratio of 17.9. At 17.1, this would essentially have a PEG ratio of 1. So it's just slightly above that, but the company's growth coming out of the recession has been 17% per year, which is excellent. Now, when I add monthly closing stock prices to the graph, you see that the stock price has actually moved along with earnings, and there are periods where the price fell below the orange earnings justified valuation reference line, and then there were periods where the price was above that, as it was through these periods of time. Then it corrected pretty dramatically by October of 2016. Then we had a nice rally in the stock up through April 28th. And then more recently, the stock has fallen about 10% to current levels. So it's very close to being on this line. I'd like you to think of this line as a range, even though it's drawn as a specific number here. So if I was to simply calculate performance from this point going out to year end, and assuming here even a little bit of PE ratio contraction, an investment in Lowe's has the opportunity to generate a 13.5 to 14% total rate of return out to the end of 2019. So I consider that very attractive for a total return investment. I'm a firm believer in investing for specific investment objectives. However, having said that, I do want to point something out. Forecast earnings growth going forward for Lowe's is about 13.3%. There are 26 analysts who forecast earnings growth of 16.04% for this fiscal year, which actually ends on January 31st, 2018. And then 27 analysts forecasting 14% beyond that, and then 12.7%. So this orange line on the forecasting calculator is actually drawn at a PE ratio of 15. The 17.9 PE ratio would obviously equate to this 18 PE ratio here. So if I then add the normal PE ratio to this graph, I'm using the 5-year normal PE ratio of 20.9. So this blue line now is a PE ratio of 20.9. However, I'm going to go ahead and look at the historical normal PE ratios for this company. And just to be conservative, I'm going to pick the lowest long-term historical PE ratio of 18.3. And then just by pointing to these future points here, you can see that you've got double-digit rate of return calculations going out here. If you go back to that 17.9, 18.3-ish, we'll call it 17 to 18 PE ratio, this company could easily generate double-digit rates of return going forward. I think the company is attractively valued today on that basis. Now, in the intro to this video, I also promised to look at valuation from different perspectives. I talked about looking at it from a standpoint of operating earnings, which I think are very important here. So let's take a look at how Lowe's is valued relative to the company's operating cash flows. I said earnings before I meant cash flows. Now, the normal priced operating cash flow for Lowe's since the beginning of 2011 has been about 11.5, which is precisely what the company trades at now. So I would call that attractively valued based on an operating cash flow basis. I also think it's important to note that the payout ratio of cash flows are much lower than the payout ratio of earnings. This kind of indicates to me that the dividend is relatively secure and very likely to continue growing. Even more to the point, let's take a look at free cash flow. When I look at Lowe's free cash flow, I see another very strong valuation reference here. The company's generating obviously very excellent free and consistent free cash flow. And again, free cash flow more than covers the company's operating history. And finally, I'm going to look at earnings before interest, taxes, depreciation, and amortization, or commonly known as EBITDA. And when I look at Lowe's companies from a standpoint of EBITDA, I once again see that the company is fairly valued. Its normal price to EBITDA has been about 8.2. It's currently trading at 8.4, which is perfectly in line with that. So if you're looking for a total return investment that's reasonably valued relative to the company's potential growth, then I think Lowe's fits the bill. I actually like it a little better than Home Depot here. And let's take a real quick look at some of the valuation references on Home Depot relative to Lowe's. From an EBITDA point of view, Home Depot is moderately overvalued. From a free cash flow point of view, and again, I actually like both of these companies, from an operating cash flow or free cash flow point of view, Home Depot looks rather significantly overvalued. If I go into adjusted operating earnings, then I would also argue that Home Depot is significantly more overvalued relative to Lowe's, which is currently fairly valued. I actually like these companies. I consider them almost interchangeable. If you remember the long-term perspective I showed you here at the beginning, I just like Lowe's as a better value here. I like Home Depot a lot as well, but I would like to see Home Depot a little cheaper than it is now. So if you're looking for total return, a long-term investment in a Dividend Aristocrat that has a moderate yield, or at least a market value yield, you might want to take a closer look at Lowe's. The company is not necessarily real cheap today, but relative to the market, relative to its growth rate, it actually looks pretty attractive today. This has been Chuck Carnevale saying thanks for watching, and look forward to talking to you again soon.